they're literally price fixing everything when they're trying to micromanage the interest rates. And so, we're just looking at a microcosm in that story that Kenny just told us. But you expand that throughout the entire economy of 350 million people, where there's literally billions of transactions occurring daily.
Yeah.
And you think about the economic distortion that's created by a central planning approach to interest rates. Right. And then you just look at the Fed and you say, what the hell are we doing here? This is insanity.
And we've talked about that a lot. Why should some central body like a central bank fix the price of money when the market should determine the price of money, the value of it? Yeah,
absolutely. Right? Well, what's ironic is all economists, whether they're Keynesian or Austrians, they all think price controls are a bad idea.
And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome to episode 1918, and greetings from beautiful Scottsdale, Arizona. We've been holding our Collective Mastermind event here this weekend, and we just concluded it. It's been a great weekend, and I thought I would have a chat with a couple of my good buddies and business partners here. We got, of course, Ken McElroy and George Gammon.
What's up, everybody?
So we thought we'd do a little show for you, but how'd you like the weekend?
I thought it was great. Yeah. I mean, the weather's spectacular in Scottsdale. People flew in from everywhere, and we had an incredible collective, as we have had. This is our 5th event, so it's been great.
It was really great, and we did a different thing this time. And I'll tell you, even if you're not interested in joining a formal mastermind group, the mastermind concept is so powerful. And, we did that this weekend, and it's just been great. We did kind of a forum training to get that. Why don't you explain what that is to people? I mean, I think that's a really valuable thing you can use this yourself in your own life. You don't need us, so, yeah.
So what you do is you just break them up into smaller groups, like, let's say groups of 8. And then you share at a deeper level using a system of tools, and you can kind of tackle business issues as they come up, as opposed to sometimes it's hard when there's a big group.
Yeah, absolutely. It's good stuff. And George, it's good to see you again, buddy. You came a long way for this.
Yeah, but it's well worth it. That's for sure.
Yeah, good stuff. Well, let's, I want to get your take on what's going on in the world. Obviously, a lot is changing. It's changing very quickly. People are rightfully concerned, I think. Ken, what's your outlook? Ken, of course, specializes in large multifamily properties, and so he has a great understanding of construction cost, rents, tenant quality, all of this kind of million other things, of course. But go, I'll just let you tell.
It's an interesting time because, construction costs are up, cap rates are up, interest rates are up, labor costs are up. Yeah. Supply costs are up, so it's a rough time, but it's all kind of normalizing. So we're starting to see some of the sellers are starting to adjust their pricing, and because interest rates going up are creating less cash flow, especially if you have any kind of variable debt or anything like that. So we're struggling a little bit on our renovations that have bridge loans or variable loans. We're solid on anything that's fixed, and then any construction. So I think you're going to start to see some trouble on a lot of these big large bridge loans or variable loans or short-term loans.
What that means is a lot of these apartment developers have taken out short-term bridge loans, and what are those? Usually about a year or so.
Well, to build a property, you might get a 3-year construction loan. So, and that's because there's no property. They can't do a fixed loan and there's no collateral.
Right.
So, so you have this variable loan. So if you started building something a year ago when rates were, say, 3 or 3.5, now they're 7.
Yeah.
That's significant on that same amount of construction principles. So a lot of that's starting to show up now. So people that don't have really good reserves, a lot of cash, you're going to start to see some things, they're going to have to recapitalize, and there's going to be all kinds of things happening here. I think 2023 is going to be very interesting.
One of the questions people are talking about a lot in the multifamily housing market is it overbuilt? Has there been too much construction the last few years? And then, of course, different market tiers and geographies, of course, but Class A, Class B. And no one builds Class B or C. Everything that's built is Class A or A plus, right?
Yeah.
So is there an oversupply coming, or are we still okay in
Yeah.
terms of supply demand?
Well, I don't ever believe there was an oversupply.
Okay.
So, and I'll tell you why. If you take a look at the demand for housing, we're still millions of units underneath that demand.
Yep.
So now you might have a little bit of oversupply in some specific markets for a short period of time, but really, because interest rates are up, construction costs are up, land costs are up, then that that deal that maybe you could do 2 years ago, 3 years ago, you can't really do today.
Mm-hmm.
So we're heading into a shortage, in my opinion. The other piece is as single family rates go up, then their mortgage payments go up. So they're in other words, there's less people that can buy homes because their mortgage payments going to be significant, and they're sizing to their mortgage payment.
Yeah.
So on how much they can afford. So I think that's just going to force more people into rental housing.
And I think that's hugely significant, by the way.
Yeah.
What I said last week on the show was, buyer's market, seller's market, I don't care, the rent is due, right? And that was the show I recorded on November 1st, right? The first of the month. That's what real investors invest for. They invest for yield, right? Not speculation. Right. And it's funny that the whole conversation is about, are prices going to go up or down? And so little of the conversation is about yield and about rents and about just what you said, which I think is a really important element.
I'll give you one quick example. We had a property in escrow, and the cash flow was $3 million. Okay. So it was a big project, hundreds of millions of dollars.
Yep.
The debt costs went up while we were in escrow.
Mm-hmm.
And luckily we didn't have any non-refundable money or anything. So we were in due diligence, but the debt costs went up and cut $1 million of our cash flow out. So we went from 2 million or 3 million to 2 million because the debt costs went up. Exact same.
One third.
Exact same property.
Wow.
So, and that happened. And so these 6 rate increases that we've had since March are impactful.
Yeah.
And so it's driven the interest rates up. So you're always trying to size to cash flow. So 3 million to 2 million, let's say, in cash flow is significantly different.
Mm-hmm.
So we passed.
So now the seller is left with that deal. They basically bought it back from themselves.
Well,
right?
Yeah. Well, we had it in escrow. We never bought it, of course.
Right.
But what we did is we just let them have it back. And they said, why don't you make us another offer? And we said, rates are still going to go up. So we're not going to. And but we sized it at about a 20% discount.
Mm-hmm.
So from where we had it in escrow, based on the cost of the debt.
Right. Very interesting. Very interesting. George, you cover all sorts of stuff in the macro world. He's the self-proclaimed macro addict. I love that, by the way. What would you like to share with our people? It could be anything. The geopolitical stuff, whatever.
Well, I'm just listening to what Kenny's saying. And I'm just thinking to myself how insane it is that we have a small group of 900 PhDs that are literally fixing the price of money.
Yeah.
You think about how this is impacting Kenny's world.
Yeah.
And that's, you scale that through the entire United States, 350 million people.
Uh-huh.
And you've got them trying to micromanage the economy, from this tops down type of approach. And they're not just trying to manage it here and there. They're managing the price of money, which is 1/2 of every single transaction.
Right.
You see, so
that's a really interesting statement.
People always say that, how should we manage the economy, George?
Mm-hmm.
You let prices, price discovery, prices are what should manage the economy, especially the price of money.
Uh-huh.
And so if we just had market rates, you have all the windfall profits when the rates are super, let's say, artificially low.
Mm-hmm.
And then you have this boom bust cycle that's created ironically to try to flatten out or smooth out the boom bust cycle.
Right.
But you see how the pig moves through the python,
mm-hmm.
right? There's a big lag effect with interest rates.
Yep.
They take it from, let's say, 0 up to 3% or 4%. But then that doesn't immediately impact the economy, because all this stuff that Kenny's talking about, that has to filter through the entire system. And this is why the Fed is always behind the curve. Why they always tighten until they break something,
right?
And then all of a sudden, like, oh, we couldn't have seen that one coming.
And then they overreact on the other side of the equation, right?
Yeah,
yeah. It's always this violent swinging.
Yeah,
right?
and it just goes to show you that that's just another proof is right here in front. We're living through a time in history that's proving to us how important the price signal is, and price discovery, and they've completely gotten rid of the most important price of all.
The price of money.
Correct.
Right. Yeah. So what was interesting is you said the price of money is at least 1/2 of every transaction.
Well, money is 1/2 of every transaction.
Tell us more about that. That's an interesting statement.
Well, even this water right here, you have to pay for it.
Yeah, sure, of course.
That's how you pay for it, money.
But why do you say it's 1/2?
Because half the transaction is what you buy, and the other half of the transaction is the money you
So it's the goods and the symbolic, currency you're trading for it.
Yeah, whatever you're buying, whether it's this computer, whether it's this hat, or our collective outfit here, money is the other half of that transaction.
Right.
And so they're literally price fixing everything when they're trying to micromanage the interest rates. And so, we're just looking at a microcosm in that story that Kenny just told us. But you expand that throughout the entire economy of 350 million people, where there's literally billions of transactions occurring daily.
Yeah.
And you think about the economic distortion that's created by a central planning approach to interest rates. Right. And then you just look at the Fed and you say, what the hell are we doing here? This is insanity.
And we've talked about that a lot. Why should some central body like a central bank fix the price of money when the market should determine the price of money, the value of it? Yeah,
absolutely.
Right?
Well, what's ironic is all economists, whether they're Keynesian or Austrians, they all think price controls are a bad idea. But yet somehow fixing the price of money is a good idea.
I know. Well, I can't wait to get into this topic. Our next event is in Jekyll Island.
Yeah.
So we're going to be in the Federal Reserve room.
That's the birthplace of the Federal Reserve. Of course, many of you have probably read the book, The Creature from Jekyll Island by the great J. Edward Griffin, who's been on the show a few times.
Yeah. And so George is bringing all his buddies, to talk at that. That's going to be
we got Joseph Wang. He's going to be great.
Oh, my
and he's been on the show too.
Yeah. And Robert Barnes.
Barnes and Joseph Wang. And nobody knows the system of how the Fed works better than Joseph, because he was the lead trader at their trading desk in New York. So he was the one that actually did quantitative tightening and quantitative easing.
Right.
Yeah.
And so he'll have some great stories to tell. But I think he would be the first person to say that we should get out of the business of fixing the price of money.
Yeah. Okay, but that's probably not going to happen anytime soon, of course. Do you think these rates are going to moderate? I mean, they're probably moderated at some point, obviously, but will they go down? I mean, what's next year look like? I mean, I know interest rates are impossibly difficult to predict.
Yeah, I think you look at the bond market, they're telling us that interest rates will probably be lower in 2023.
Yeah.
That doesn't mean that you can get a loan. See, that this is people have a misunderstanding here. They think that if money is cheap, then it's loose.
Yeah, there's a difference between mortgage credit availability and mortgage prices.
Yeah, what you notice is usually when money's cheap, it's actually tight.
Yeah.
It's actually tight. So 2012 was a great example of that. I had all these properties that I owned outright, and I couldn't get a line of credit at 40% LTV. The bank wouldn't touch it with a 10-foot pole because they thought that real estate was just going to go down forever. So that's a good example with low interest rates and tight money.
Yeah, exactly. So I've shared before the charts from the Mortgage Bankers Association, the MBA, and they publish an index called the Mortgage Credit Availability Index that shows that availability, which most people don't think that much about it. They just think, oh, mortgages are cheap, I'll just go get some mortgages. But availability, because what they do is they make it more difficult to qualify. And so you really can't get it. It looks great if you can get it.
Yeah, that's what you hear everyone talk about. Oh, just wait, interest rates will go down, the Fed will pivot, and then I'll just go ahead and refinance or blah, 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 blah. And it's maybe not.
Yeah. What are your thoughts on interest rates in the future?
Well, I hope they do go down. We're going to need it. By the way, I think the only thing that's happening is this bubble that was created prior to this is just now normalizing.
Yeah.
And people are freaking out, But when the Fed went down to zero or almost zero federal funds rate, that's what created this.
Yeah.
So this is just normalizing. So for me, this is all part of a long-term strategy. It's normal.
Yeah. Yeah, good stuff. What else would you like to share? Just questions I haven't asked you, just anything you're thinking about, anything that's top of mind, should be top of mind for investors.
So I think today it's all about capital preservation, not necessarily capital appreciation. But the people that have been paying attention, I'm assuming most people watching your podcast are paying attention. You could see this one coming, from a long way away. When you can't shut down an economy and expect it just to turn back on like a light switch, especially when you create all this artificial demand with quote unquote free money. People's checking accounts are still a lot higher today than they were in 2018. The problem there is that their incomes have not gone up with the rate of inflation. So although they might have a little extra money now than they did in 2018 because of the stimulus, not having to pay mortgage or rent or student loan or et cetera, that's going to fade very, very quickly because their purchasing power is a lot less because of that delta between inflation and their incomes increasing. So we have had negative real income growth. And so at a certain point, they're going to drain their savings. And that's when we're going to run into a real problem as far as aggregate demand. I think that's what the yield curve is sniffing out right now. It is true that you have this back and forth between real estate prices and rents, but that is a derivative of income. So if I think we could be moving into a world where the unemployment rate's going to go up significantly, and I think people with a lot of those A properties, A apartment buildings or like the houses that are not your starter homes, they could be in a pinch
as people have to move down the socioeconomic ladder.
That's right.
What do you think about that, Kenny?
Yeah, it's happened before. So it's happened in other cycles. The other thing I think is managed money. Got to think about this. Most people don't think of managed money. So managed money is used to buy and build projects, big projects. So think of Wall Street, think of private equity, think of family office. That money wants its money back, in like 3 years, 4 years, let's say. The value that they thought that they were going to get, let's say 1 year ago, 2 years ago, versus what they're going to get in a year is going to be different. So that is, I think, something really to watch.
And the reverse wealth effect.
So you could even if you had a value add, if your NOI, if you're able to grow your NOI through some value add by, let's say 20%, and your cap rates go from say 4 to 5, which is also 20%, your net effect is 0. So you literally, your exit cap rate is higher than your buying cap rate. That's going to create a lot of problems for the managed money because they're going to want their money back regardless of what's happening with the property.
And are those mostly pension funds?
They're insurance companies, pensions funds, a lot of syndicators, a lot of, I call it broker dealer, family, family office. Yep.
And another thing that's interesting about rates actually going up is it gives large pools of money an option they haven't had for a decade.
Right. They have other options they can invest in more fixed instruments that pay higher rates.
Let's look at like BlackRock or Blackstone or whatever. They for the last decade when interest rates are at 0, to get any type of yield,
you had to do
real
risk
estate.
curve.
That was pretty much your only play was tenants and toilets to get over, let's say 3 or 4%. But if you've got the 10-year, let's just hypothetically say that the 10-year is trading at 10% or 6% or something. Now, does Blackstone want the tenants and toilets for 5%, or do they want that 10-year treasury at 6 or 7?
Exactly right.
So that could add a little more supply there that is obviously needed. But there's a lot of volatility right now. That's the bottom line.
Yeah, it's a crazy time. Sometimes it's more important, the return of your capital is more important than the return on your capital. So good thing. Give out your websites, guys.
www.kenmcelroy.com, KenMcelroy.com.
Or just George Gammon. The last name is Gammon. You can just Google that and all my social media stuff.
And we've got a collective website, quite literally,
That's right.
which is thecollectiveadvisors.com as well for our mastermind group. So
if you're interested in that, we're going to go to Jekyll Island next. Go to the website, sign up, and we'd be glad to see you.
We'd love to see you there, and they'll also be at our event coming up in Scottsdale in January. So
I'll be there via Zoom.
Via satellite.
Via satellite.
Yeah.
I'll be there in person.
All right. Happy investing, everybody.
Bye bye.